Hey everybody, good to be here today. My name is Brent Moore. It's time for advanced. Excuse me. It is managing an options portfolio today, and glad you're here. I'm joined alongside Ben Watson, who's helping me out in the chat. Ben's very familiar with options and managing an options portfolio himself. And so, as you have questions, feel free to type in those questions in the chat between Ben and myself. We'll do our best to get your questions answered. And so, what are we talking about today? What I want to talk about today is this. You may very well have a misguided perception, and we all have misguided perceptions on things, but on when is the best time to exit options, okay? And so that's what I want to talk about today. When is proper time to exit options? And this is what I'm going to say isn't an absolute, recommendation that you need to do it this way, but I want to show you about some common misperceptions that people have. That's what I want to talk about. Now, what I want to do is I also want to just mention that you can follow Ben or myself on X at BrentMooreCS, at Ben Watson CS. And, Ben is a very experienced market trader, participant. And I've been working with him for over 20 years now. So he's been a good resource for me, very knowledgeable. So I encourage you to follow him on X. Now, options do carry a high level of risk and are not suitable for all investors. And the information today is presented for general informational purposes only. It's not an individual recommendation or endorsement of any particular security, strategy, or chart type. Schwab does not recommend the use of technical analysis as the sole means of investment research. We're going to be looking at Paper Money today. The Thinkorswim desktop software platform, which is what we'll be using, is used for educational purposes only. All investing involves risk, including loss of principal. All short options can be assigned early, regardless of the in-the-money amount. And with stop orders, there's no guarantee of that execution of the stop order that it's going to be at or near the stop price. All right, so there we go. Let's take a look at the market, because today's kind of a big day. I know it's something that we've been thinking about for a long time. We've been looking at April 2nd. Why April 2nd? Today is, the tariff day announcement. Well, the actual announcement here is coming out. The White House, I guess, is releasing a statement at 4 o'clock Eastern time, which coincides exactly when the market is closing. So in terms of today, we're kind of in this limbo day today. I know we were looking at today, but it's actually right when the market closes. But let's take a look at what we're doing intraday. You can see, here's the drop off we've had in the S&P 500. Kind of a big bullish engulfing type candle here today. But what it looks like can change within a day very significantly. If we look at yesterday's trading, look at the swings that we had in yesterday's trading. This is just 5-minute candles on this chart right here. So far, we opened up down. We've moved our way up. A little bit of maybe a bull flag intraday, but still going up. But, a lot of things can change tomorrow there. So, that's the S&P 500. And obviously other indexes, the NASDAQ would look relatively similar right now. And I don't want to spend too much of our time on that, because what I want to talk about today are some common misperceptions on exiting specifically short verticals. But I think that what we're going to talk about today is going to be applicable to other trades as well. So that's one thing, your perceptions on short verticals. I want to talk about probability of touching and probability of in the money and the relationship between those two items. I want to show you some example trades on kind of implementing what we're talking about in terms of exiting option strategies. And I want to talk about managing option positions. So I want to just start with an example here. And I'm going to start with an example on we'll say Nike. Okay, I'm going to pull up Nike. It's a company you all know. I'm going to assume this is a downward trend. I mean, it is a downward trend. That's what we've seen. I'm going to assume more of a bearish posture on this trade here. And I'm going to do a short call vertical as an example, but I want to talk about our expectations on where we should possibly get out of this trade. Now, a short call vertical, so for those of you who are not familiar with that, I'm just going to abbreviate as SCV, short call vertical, means you're going to sell a call above where the current stock price is. Current stock price is around 64.5. You can see right that there. And I'm going to buy a call or do a long call at a higher strike. And we want the stock to stay below that short call, whatever short call we do. And there's different ways to do it. And one way is to look at the technical analysis of this trade and things like trends and resistance levels and stuff like that. However, another thing that sometimes we'll do in this class and other classes that I teach, and Ben will talk about this as well, is we'll use probabilities. And there's different ways of using probabilities. Often we'll use delta as a probability. In other words, if I go to the trade tab and look at Nike here, and I'll just go out a month here, often what we'll do is we'll look here and we'll look at delta. Okay, here's delta. Delta is an option Greek that just tells you how much an option is going to move in relationship to a $1 stock move. Okay, so a $1 move in the underlying stock, we're going to expect approximately, and that's emphasize that approximately, about a 56-cent move in that option price. But we also use that delta for probabilities of the stock, of the option being in the money at expiration. Okay, it being at expiration. Question in the chat from Ben, is this also referred to as a bull call? No, this would actually be a bear call spread, So it's a good question. Options can be a little confusing, folks, because of the terminology. A short call vertical is the same as a bear call spread. A long call vertical would be the same as a bull call spread. Okay, so yeah, it gets a little confusing, doesn't it? But sometimes we'll use this as a means of looking, delta as a means of trying to say, hey, I want this to stay out of the money. Because remember, for this trade, we have a short call, presumably above where the current stock price is. We want the stock to stay below that short call price. Okay, that's our expectation. Okay, that's what we want. We're not going to do that trade unless we think that's a high likelihood. And so we'll use that delta and we'll say, hey, well, what if we have, say, a 35 delta? That's saying there's about a 35% chance of this stock, if we just leave this going to expiration, of being above 67. Okay, so we want the stock in this case to stay below 67 if that's going to be where our short strike is going to be. So we could sell that right here, and that sounds great. But that means that's kind of a higher probability trade because that represents a max gain if we stay below that 67 level. Right, max gain sounds great, right, at expiration. But that 35% chance, remember that is just an approximation. That 35% chance is, we can look at that a different way. We can also say, well, what about, instead of using delta, there's an option Greek called probability in the money. And when we look at that, we're going to see, oh, there's a little bit of a variance there between our delta column and our probability in the money. And those are just estimations. One's not right, one's not wrong. They're just different models for coming up with what that probability potentially is. And you'll see there's a few point difference, and sometimes they may be exactly the same, but typically they're going to be off a few points from one another. But it gives you the idea, right? 32.5% versus 36% is what that's saying. At expiration, that's where it's going to be. But I want to show you something else. Let me switch this delta to a different option indicator, and that is probability of touching. And I want you, let me get a few more strikes on here. And I want you to look at the relationship between the probability of touching, this is this column right here, and the probability of it in the money. Now, for those of you who are, this isn't super complex math, but I want you to look at a pattern here. Look at the relationship between this number right here. Let me get my little marker tool out. This number right here and this number right there. Okay? We'll do the same up here. Look at the relationship between this number and this number. And what about this one? This number and this number. Do you see a relationship between those two? This is probability in the money, or it's going to be approximately what delta is, and probability of touching. What is that relationship? And I'm going to let you put that in the chat there as we're going here, because I want you to think about that, because this is a key level. If we are saying the probability in the money is we want to keep that low because we want a higher probability of it being out of the money, that's how we're looking for a higher probability trade, then the kind of that notion can kind of break down when we look at that probability of touching. Because if we're saying it's a high probability trade, but if we look to get out the second we hit that price, is it a high probability trade there? Let's look at that one contract, and you guys are right. It's about 50%. In other words, one way to consider the probability of touching is your probability of touching is basically, if for an out of the money contract, is going to be basically twice what your probability in the money is. So if we're looking at that 67 strike, here's our probability in the money, and we're saying, oh, that's high probability of it being out of the money. In other words, take 100 and subtract that. Where's our high probability in this case if we were to get out the second it touches it? It's gone. In other words, there's only about a 35% chance of it not touching that price at some point. If we got out every time we just hit the short strike, in the case of a short vertical, that would be a problem. Okay? That is true for short put verticals as well as short call verticals. Right? So in other words, our rule is typically not going to be the second it hits that short strike, we're going to get out of this trade. Let me just give you an illustration of that. The general summation is this. A trade is likely to move against you during the course of the trade at some point, to some extent. But even if it moves against you for a ways, there's a very good chance it's going to recover. Let's go back. We'll come back to Nike in just a sec. But what I want to do is I want to go to an example trade that we've been in for a little while. Let's look at Disney. And we're doing okay on Disney. We're up a little bit on Disney on this trade right here, up about 33 bucks. And we entered this Disney trade on the 13th, March 13th, okay? Notice my short strike. This is a short call vertical, okay? It's short vertical is 100. Let's look at Disney here. Let me go back to Disney. DIS, okay? Short strike was 100. We entered the trade on the 13th, which was right down here. And what happened? Okay. We said, well, look, there's kind of maybe some resistance up here. We did our short strike there. Sure enough, what happened to that stock? It went against us. If we exited that trade, and of course, hindsight is 2020, isn't it? This stock could have just kept on going up and up and up, and we'd be in a losing position right now. But what happened is we entered a trade, it went against us a little bit, and boy, that happens a lot, but then it reverses itself. Think of how many times you see a stock go up a ways, but then it retraces a little bit, okay? Or down a little ways, and then it retraces a little bit. That's what we're talking about here. And so the general rule is, if you're doing a short call vertical and say we pick 100 strike, we're not necessarily going to exit right at that 100 strike. Or let's say we did a short put vertical and we had a 95 strike. We want to exit just because the stock hits that 95 strike. And what the reason is, there's just a high likelihood of it going against you there. Let's go back to Nike here in a sec, okay? So here's Nike. And I'm going to go out about a month, which is kind of an area, a time frame, a general time frame that often we'll do on these short vertical spreads, both short call verticals and short put verticals, because time decay, if these are done out of the money, is going to benefit you. And time decay is at a higher level, a higher rate when we start to get kind of under the month time period here. And so we want to take advantage of that higher time decay. So very often we'll look somewhere in the, I don't know, 20 to 40 day range. I'll split the difference and go right at 30 here for our short verticals. So what I'm going to do here is I'm going to go to my probability in the money, and I'm going to go to somewhere in the 30 to 40 range, keep it a higher probability in the money, realizing at the same time, there's a good chance it may go against us at some point. And I'm going to click on the bid price to sell that. Now, it's going to be a spread, so I'm also going to go to the ask price, and I'll just go out $1 more to the 68. I'm going to hold down my control key on my keyboard. And the reason I'm holding down my control key when I click on that ask price is it then adds that additional leg onto the initial one, and we end up with a spread. If I don't hold down the control key when I do that, it's just going to overwrite the 67 with the 68 and just replace it, okay, basically, which I don't want to do. And here we go. This is the trade. And this needs to be a higher probability trade because our reward to risk on these when we do these out of the money is we're going to risk more than we potentially gain. The most we can make on this vertical spread is the initial credit, in this case, 30 cents or so, okay? The most we can lose is basically the difference in the strikes. 68 minus 67 is $1, minus the initial credit is 70. So we can potentially lose more than we potentially gain, but it is a higher probability trade. But if we're going to put an exit on this trade, what we're not going to do is we're not going to get out just because it hits the 67 mark. Okay? One thing we may do is we may look at the chart. Let me go back to that chart. And we may go, well, look, here's that 67 mark. I'm not necessarily going to get out. I'll draw this roughly at 67. Okay. We'll call that there. We're not going to get out just because it hits that. I'm going to give it a little more wiggle room. I'm going to consider this to be probably a significant resistance level. And if we break above that, then I'll get out. So maybe I'll go, that's around 68 and a half. If I go, we'll say above 69, probably 69 and a half. If we break above here, maybe I'll get out at that point. Okay. Now you may be saying, well, am I going to be at a max loss at that point? Well, at expiration, you would be at a max loss at that point. But remember, the price of these options before expiration and the price at expiration are very different things. Let me just illustrate that. I'm just going to shift this to show a vertical spread. We're going to look at that 67, 68 vertical spread. And I'm going to change this to a Theo price calculation. So let me just reset this. Okay. And what this is telling me is this is the theoretical price of this spread given some conditions. And I'll tell you those conditions in just a sec. And right now, the theoretical price of this 67, 68 it's showing around 28 cents. We may be able to get in a little better price on that, but wait, yeah, 29 cents right there, okay? But look what happens to this price if the trade goes against us. We're going to say the stock goes up to 69 and a half. So let me move this up $5. Okay, we'll say it takes a few days to get there. So it goes to the end of next week or so. Okay. Why is that not? That should, let me click my enter key. There we go, 69.5. And let's look at this here, okay? So the 67.68 price it's certainly more. We will have lost money, no doubt, but it's at 77 cents. Remember, this thing can go up to $1. It can go up to theoretically, that can go up to a whole dollar. Okay. A max loss would be if we hit a max theoretical loss is if we hit $1 on that trade. It's only at 77, and that's which again, it represents some money lost, no doubt, but that's assuming the stock goes all the way up to $69.50 on that. Okay? So let's put in that trade. Let me go back here. Here was our trade, and I'm going to put an exit order on this trade. What I'm going to do is I'm just going to change my single order to first trigger sequential. I'm going to right click on this. I'm going to create an opposite order. This initial order gets me in. The exit order is going to get me out. The contracts that I'm selling up front, I'm buying to get out, and the contracts I'm buying up front, I'm selling to get out. I'm going to change this to a market price. I'm going to make it good till canceled. I'm going to go to my gear over here. I'm going to click on that gear, and I'm going to say, I want to get out. So I'm going to go under where it says symbol here. I'm going to say if Nike marks greater than or equal to, and what do we say? 69.5, I think. 69.5. I'm going to get out at 69.5 if it goes up. Now, does that guarantee us any sort of price exactly on what this is? We ran the theoretical price on it, but we don't know exactly what that price is going to be. Furthermore, we don't know if Nike's ever going to touch 69.5. Nike could gap up to, $80 tomorrow or something for all I know. Probably unlikely, but it is possible. So that isn't going to guarantee we're saving us from a max loss here. But that is an exit that gives us a higher probability trade on this, and also gives us a reasonable exit point to try and save some money on that. Let me just kind of point out one other thing, and that is, let me go back to single here. We said 69.5. What's our probability of touching on that 69.5? Probability of touching 69.5. I don't have a 69.5 strike, but it's basically, it's going to be in between these two prices. So maybe 38% or so probability of touching that we get up there. That is a high probability trade. If we just exit at the short strike, it's not a high probability trade. Okay, one other thing I'm going to do is on this, that's my mid price. We can see if we can get filled on that. I'm just going to move that down just a little bit to try and ensure we get filled on that trade there. We'll go maybe to 27. And I'm going to confirm and send. I'm going to add this contract to our short verticals bucket, and we're going to send that, and we've filled, and we now have a short call vertical on Nike. Now, what I want to do is I want to address some questions, and then we'll get to another example here on this. Okay, let's see. So, let's see. It looks like Ben, you answered that one. Seth says, is this recorded? Yes, this is recorded. Good little point here. It is recorded. It's on, you can go to YouTube. We have a Trader Talks channel, everybody. Trader Talks Schwab. And the Trader Talks Schwab, make sure you subscribe. If you're watching on YouTube right now and you have not already subscribed, go to the bottom right portion of your page. There's a little button to subscribe on that. If you've already subscribed, don't hit that again. Let me also mention this. Let's see, I clicked on the wrong thing. Let me just pull this up. You can also go to schwab.com/coaching, and we have our live webcasts and our on-demand webcasts. So, if you click on these, you can see a schedule, And you can see, well, here's today's schedule. What preceded this class today was trading index options. Ben Watson teaches that class. I encourage you to check that out each week, 11 o'clock Eastern time on Wednesdays, trading index options. Great class. Ben teaches other classes as well, including market movers on Fridays. Make sure you check that out. But you can go back and you can see, you can click on past ones, past sessions. Let me just click on this one, for example, and you can go down and you can see information on that, and there's a YouTube link on those too. Okay, so you can always watch those after the fact if you like. All right. So good question. Other question: why not break even at? So could we exit at the break even at what we 67.29? Greg says. Well, let's go back to what we just said there. We could do the break even. I said the shorts, we're not going to do the short strike because the probability of it touching that is very high. Well, the probability of touching that break even point of 67.29 is also going to be very high. So again, in that circumstance, Greg, we would be transforming this theoretically high probability trade into a low probability trade if we exited right at that mark. Okay, so very often we will use that delta, or we'll use the probability in the money as a guideline on here, but in terms of exits, I wouldn't use the short strike as the exit necessarily. I can't speak, you have your own system here, but for this class, we're not going to use that short strike as an exit there. Okay? So there we go. So I want you to be aware of using the probability of touching. I want you to use this. You don't have to use this metric here necessarily, but I wanted to do it to illustrate the point here today. Okay, so there we go. Let's look at maybe a bullish example. Okay, because we did a short call vertical as a bearish example. The kind of analogous trade for a bull trade would be a short put vertical. And so let me just do this. I'm going to pull up, let's do CVX, okay? Here's Chevron, and our trend has been going up. We had a little flag, little pause maybe on this trend, but I'm going to consider this to be more of a support level here on there, okay? So this is going to be a bullish example. And that's all these trades all are example trades, okay? And there we go. So in this case, if we do a short put vertical, what we're doing is we're going to sell a put, and then we're going to buy a put or do a long put beneath that. That creates a bullish trade. We're going to try and make this a higher probability bullish trade. And this, to the prior point, it's not just called a short put vertical. You may call it a bull put spread as well, a bull put spread. These are both short verticals I'm going over today. Okay, that means we're selling for a credit up front. We want the stock to stay above our short put price, but there's a decent chance it's going to end up going below there at some point. All right, so let's take a look at this example. Now, a question on the sell order. I did an order on the previous trade to get out if the stock goes below a certain price. Could we also exit if the stock hits a particular price? On the good side of things, on the side of us making money? Sure could do that, absolutely. That's no problem. In that case, instead of doing a first triggers just sequential order, first triggers all order, you do a first triggers OCO order. So you can do them both ways on that, all right? But let's do a bullish trade here on this, on CVX. Let's use our measure here of probability in the money. So let me go probability in the money again. And I'm going to look on our put side because we're doing a put trade here on this. And I'm going to go about a 35% probability in the money. That gives me a 162.50. That's going to be the short strike. And then we'll look and we'll go out of the money just a little bit more for our long strike, and we'll do a 160 long strike. Our nominal probability expiring in the money is about 34, 35%. High probability trade. But the probability of hitting that at some point along the way is about 67%. Okay? About 67%. So that's why we're not going to get out right when it hits 162. We'll go down a little. We'll give it a little bit more wiggle room here on this. Okay, so let's look at the chart here for a sec. So I can go down. It can break down, and we can use a technical exit if we want. Probably, I'll go and say, hey, maybe that high is an exit here somewhere this high, or maybe this level down here is kind of a potential support level where we went up and bounced off it several times. We can use that as a support level. We could use the break of our 20-day moving average as a level. Now, if I'm using the break of the 20 moving average, I'm probably going to give it a little wiggle room in case it gets down below there. But those are all ways of doing that trade. Additionally, well, let's go here and let's look at our trade. So if I want to do the 160, 250, 160, I showed you how to do it before by clicking on it and then hitting the control key. You can also go to spread vertical and do it this way. You can go here and do the 162, 162.50. The reason why I often start on the single trade is because when we're looking at deltas, let me pull up a delta here. Okay. Pull up delta. Sometimes people get a little confused on this, and you can't use the delta here as our measure because this delta right here is the combined delta for both strikes because this is on a vertical. Okay. So 162.50, 160, we're going to look to sell this. It's a credit spread. There it is, 70-cent credit. What's our reward to risk ratio? Here, well, I can click on confirm and send, and I can look, and here's my max profit, here's my max loss. Again, we stand to lose more money than we stand to gain on this if we hit our theoretical max profit versus our theoretical max loss. That's no problem because it is a higher probability trade. And now, what we were saying before is we can look to get out at some point. We could do a first triggers OCO order. And in this case, I can create an opposite order. And now I have an exit that I can get out on the high side or the low side here on this. So here's my entry price. My stop, I'm going to use that. I'm going to say my break of my moving average, and my moving average is right now about 161.5, and I'm going to go down below that about 1%. So that's going to put it right around 160. That's right around here. So we're giving a little more wiggle room. I'm going to say a 160 break. I'm going to click on market, good till canceled. I'm going to click on my gear, and I'm going to say if CVX marks less than or equal to 160. Then we're going to get out of this trade. Again, we're not going to use that short strike as our exit. Now, I have this other trade right here, and this is to get us out. This is to buy it back. But in this case, I'm going to do it from a profit standpoint. I want to get out of this if I've made 80% of what I can make. Well, what's 80% of making 63? Well, if I get out with this is only worth 20% of that, well, 20% is going to be about 12 cents. Okay, so I just went 2 times 63 is about $1.25 or so. Okay, move the decimal point over 1 is 12 cents. Or you could just say take your calculator, go 0.2 times 0.63. That's going to give me 20% remaining in this trade. Okay? It's 12.6. I'll round up to 13 cents. Okay. In other words, now if you're newer here, you may be going, well, that's losing money if it goes from 63 to 13. No, this is a short contract. This is a short spread. We want it to go down in price. So, because we're selling it up front for this amount, we want to buy it back for a lesser amount. So this is a profitable scenario. Again, in this case, it's going to be a limit price, okay? That's our target price, 13 cents. It's going to be good till canceled. And now I have what is called a first triggers OCO order. I'm entering this trade. That's the first part of it. The first part means the rest of this trade isn't even going to be valid unless we enter this initial trade, unless this initial trade fills. Okay. The OCO part stands for the one cancels the other. Okay. In other words, if the stock goes against us and we sell out of this with this order is going to cancel out. So we don't have two lingering sell orders out there, let me restate that, so that we don't have a lingering sell order after we've completely gotten out of the trade. And the same thing is true. Let's say we hit our profit target and this one fills, it's going to cancel this one because we don't want that lingering sell order to still be active in that case. Okay, now, there we go. So that's the trade. Now, how are we going to position size? Well, we're going to position size probably, in this class at least, we're going to position size to our max loss. What's our max loss on this trade here? Well, our max loss, we can click on confirm and send, and it's going to tell you here, max loss for one contract is $187. Okay. Let's say we're doing a 1% position size of our options portfolio, which is probably a fairly standard type amount. Let's say we have a $100,000 portfolio. Well, 1% of $100,000, math's easy there, is $1,000. How many contracts could we do with that theoretical max loss? If I take $1,000 divided by 187, it's going to say 5.3. So it's 5 contracts. So we could do 5 contracts in that case there. All right. So let me go and let me close this and this, and let me edit this because I'm not totally done. I'm going to go here. I'm going to go to 5 contracts and oopsie. Okay, 5 contracts on those. Now, this contract, the 162.50, we picked because it was our delta or our probability in the money was in the 30s. Okay. This is the next contract down. The gap, there was no 161 strike. We went to the next strike down. You could theoretically go to a lower strike if you want on that, but that is going to increase your possible risk on that trade too. It increases your potential return. Your initial credit would be more, but it's also increasing your potential risk. So I'm just going to go to the next strike below that. So that's for Alan who asked that question there. Okay. So let's see, what can I see those conditions again? Yeah, the conditions are going to be, you can click on the gear. Okay. And the gear, I just got to scroll down a little bit. You can see those conditions right there. Furthermore, if you enter this trade, let me just go here. Okay. We'll do that here. Okay. If I click on confirm and send, you can read your conditions right here. Your second order conditions to buy back if it goes against you is if it marks at or below $160. Okay. So that's how you can see that. Okay. Let me go and we're going to go short verticals. I'm going to click on send. There we go. We filled. We now have another short vertical. Okay. Now I'm getting a little lower on time, but I do want to talk about some additional trade management here on this. Remember though, when you're managing your options portfolio, and this is true whether we're doing short verticals or whether we're doing any other type of option trade, I want you to have three things in mind on your management. What if the trade goes, I don't know the word, well, or it goes for us, it goes our direction, what we want it to do? Have a consideration of an exit point for that, okay? What if it goes against us, okay? It goes bad. It goes south on us. Have an exit point idea on that as well. And then we're also going to have an exit point. What if it's just kind of going, say, so-so? Very often that exit point will just be a time exit. For a lot of these short exits, a lot of these short type trades, whether they're calendar spreads or short verticals or iron condors or other trades, butterfly spreads, a lot of these trades, we're going to look to get out at less than 10 days till expiration. You get a week till expiration. In this class, the way we manage them is we get out, okay? So let me give you another example. Let's look at Intel here. I have an iron condor on Intel. Now, though some of you may not be familiar with iron condors, but what I want you to do is I want you to look at it as two separate trades here. Look at this trade right here. Does that look familiar? Yeah, that's just similar to the trade we did before, the first trade we did. That's a short call vertical spread. What about this trade right here? This right here, does that look familiar? Yeah, that's a short put vertical spread, okay? So an iron condor is simply a short call vertical and short put vertical. But let's talk about managing these. Let me get rid of that, okay? How are we doing on Intel so far? It's break even essentially here on us right now, okay? We're down $1.50, not including commissions here, okay? But let's consider this. We've got 23 days to go to expiration, so we're not near that week mark till expiration. So I'd say this is kind of going so-so for us, right? It's not doing terrible. It's not doing well by any means. It's just kind of going sideways. Remember, these trades, short call verticals, short put verticals, iron condors, we're taking advantage of time decay. Theta is positive on these trades. Time decay is benefiting us, and they can be slower moving trades. We're kind of waiting for that time decay to kind of help us out here. So we're not going to get out just because of the time there. What about a profitability measure? Well, 75, 80% of our max gain, we may look to get out. Well, that's not, we don't have that. We're actually exactly break even right now. It's moving around on us. And furthermore, we may look to get out. We may have that exit point to get out. You don't necessarily have to put in a stop on these though, okay? These are a defined risk trade. This would be a very different trade if we just did a short put and a short call where our risk is huge. What's our risk on it? Well, the risk is the difference between the strike prices, which is $1. Okay, it's equal on both sides, so it's $1 total risk minus our initial credit on this, and so we're limiting our risk by doing a trade in the first place. But for managing these, what we're going to do is we're going to manage them independently. We're going to look at this call independently, and we're going to say, we're up a few dollars on this call. We're up about $4 on this call. We still have a long ways to go on this. We're down a few dollars on this put spread, down about $5 on this put spread. We're nowhere near, a max loss or there. So there we go. So don't feel compelled to do to put in a stop on these. But if you are going to do a stop, reconsider before you do a stop exactly at your short strike here. Now, you have your own trading rules. I'm not going to tell you what your trading rules are going to do, but for this class and for this class's purposes, we're not going to put on our exit points right at that short strike for that reason. For the reason I talked about today, that there's a good chance somewhere along the path, this trade is going to go against us to some extent. Every once in a while, maybe you get lucky and they go exactly your way the whole way. But usually at some point, it'll go against us a little bit. Having a little patience can help us out on this trade. All right, everybody. I want to thank you for taking some time out of your day and joining me. I want to thank Ben for helping me out in the chat, of course. Coming up next, we have a class called Trading Price Patterns. Maybe make sure you check that out. This class goes on every week at noon Eastern Time. I invite you to join me on that. Also, I teach an advanced options strategies class on Fridays at 2 o'clock Eastern Time. And that, by the way, precedes Ben's class by a couple hours, his Market Movers class on Friday. I also teach a long options class on Fridays as well. Thank you very much for joining us. Have a wonderful rest of the day, and we'll see you all same time next week. Bye-bye, everybody.